Good afternoon, and thanks very much to everybody for attending today. It's a great pleasure to be here for the first time. Let me say congratulations to our friends of VALUESPAIN for this amazing organization, and thanks very much for having me for the first time. My name is Javier Tomé. I'm an investment analyst or fund manager at Fimarge, which is a wealth management company with more than 30 years, headquartered in the Principality of Andorra, a small country here close to between France and Spain. By all means, highly focused on value investment, both through credit and equity analysis. Well, first of all, let me show the disclaimer. Hopefully you can quickly read it. Ready? Lovely. So, as I said before, Fimarge is a wealth management company with 25 employees, 4 analysts and 2 portfolio managers. Our focus is based on high-quality companies, mainly in terms of return of capital employed, mainly in Europe and US, and for which our approach looks more at quality instead of discount. So we look for high concentrated portfolios with very low rotations in our portfolios. Okay, well, I'll come to the point. I would like to tell you this afternoon about a stock called Howden's Joinery, which is a leading provider of kitchens in the UK. It is a stock we hold across our portfolios, and we consider it has a great upside. It is a 3 billion market cap stock with net cash position, sales of nearly 1.5 billion, 240 million operating profit, which means margins slightly below 16%. And specifically, I would like to talk to you about some of the reasons why the stock is unloved, and for me, despite all, I consider it is a buy. Okay, right. Let me brief you how Howden's operate and why it is different. Howden's was founded in 1995 as a business unit within the retail furniture group MFI, which after several turnaround efforts, it finally entered administration in 2008. Those Howden's official born was in 2010. They operate 690 depots, 6 days a week, Monday to Saturday, across the UK, and it has no showrooms through traditional brick and mortars, neither delivery, installation services, or national advertising. So Howden sells kitchens from local depots exclusively to trade professionals, and who then install them for end users, which are typically private landlords, local authorities, housing trust, small developers. So that's one of the key points. It has no installation services, I've just said. Howden's also built from scratch its own appliance brand, which is called Lamona, but it is completely outsourced. So it is a quite simple business model, and that's what makes Howden's different. I mean, they design and manufacture their own cabinets from only 2 manufacturing sites in Yorkshire and Cheshire, with a large distribution center in Northampton, while other products, well, including own brand appliances, are made to its specification and voting from trust suppliers. So they always say we make what it makes sense to make, and we buy what it makes sense to buy. Okay, so at depot level, Howden's has none of the cost associated with kitchens retailers. As I said before, no showrooms or whatever, since depots are normally located on industrial estates and cost a fraction of high street properties. Here, rentals are running £65 per square meter and year. Just to put into context, here in Madrid, it depends on the zone, but we are running €50 per square meter and year. And a typical Howden's depot occupies between 900 and 1,000 square meters. It costs on average £350,000 to fit out, Typically breaks even by year 2, and mature depot revenue is nearly 2 million. Well, we can find up to 4 million in some cases, but with up to 8 years of ramping up. Okay, so Holden's depots opens with a single manager, no more than 10 people, and he's responsible for growing local sales, to set up local pricing, local discounts, to manage inventories. And they say that on average, the depot manager gets up to 5% of operating profit. So incentive is quite clear here. That's one of the key points, another key points in Holden's, the autonomy of local managers. So on a P&L basis, it's also quite simple. 45% of total cost comes from cost of sales, 35% comes from personnel, and only 7% is operating leases. Breaking down P&L a bit more, only a third of cost of sales relates to production in-house. So it's much more outsourced than most realize. And also a third of cost of sales are euro or US dollar denominated. So since 95% of top line comes from its domestic market, UK, it means that the company holds a slightly long GBP positions. But no hedge are implemented here. So the accountability and financial statements, for me, it's quite clear. In-house production is mostly wood and wood-based, and from local players, and usually through annual contracts, typically linked to inflation indicators or raw material pricings and things like that. They lease all depots, warehouses, factories, trucks, offices. As you know, operating leasings are changing through the accountability. And well, before your question, and to give you an answer, the amount of future operating leases committed here is 450 million, and with annual base lease payment of, I think it's 75 million or something like that. So it means that it will be less than 0.5 times if we put operating leases when the net present value is included. The first issue they face is that, well, they plan to reach between 800 and 850 depots locations in the UK. As I said before, they are in 690 now. So the threat of cannibalization increases from here. It is clear. 30 new locations per year in the UK. Well, in fact, they plan to open 40 new locations this year. Means that they need only 3.5 years to reach a branch maturation, and it reduces support to the top line in the future. In addition, it is estimated it has historically benefit from an additional 2% sales growth from its new location setup, since, as you know, in most cases, like for like, it's a non-GAAP measure, and it does not include the latest 2 years, the latest depots open through the latest 2 years. So it can be up to a point tricky, like for like sales. But, well, since ramp-up process takes up to 8 years, it means that, well, broadly speaking, once a group gains scale and slow down the opening plan, they will begin to lose ramp-up support. However, assuming 30 new depots per year, it means they will reach its target of 800 by 2022, 2023. It depends on the pace, but in any case, from that point, we shall see 2 or more years to reach break-even in all the system. So, and that will drive sales to nearly 2 billion. 2 billion with an operating profit of nearly 340 million. So it means nearly 50% above last year, with I estimate up to 200 basis points of operating margin expansion. So what's more, last year they had only 24 facilities outside the UK, mainly in France. Accounted for less than 5%, between 3 and 5% of sales, with like-for-likes of 4.4, which is not bad. And France is the main market with 20 facilities. Well, trading from Amsterdam and Germany has been recently ceased from January this year. And for now, it is quite clear that France is where they focus on international operations. Well, indications from new management suggest that France is operating in a similar operating profile to the UK. French market has low penetration rates of integrated kitchens, and most kitchens are purchased through do-it-yourself outlets, IKEA, you know. Especially shops in a similar way to the UK. Well, French market right now is similar to the UK market when Howdens was founded more than 20 years ago. Now, do-it-yourself in UK is nearly 50%. It was 90%. Now it's 50%. So you can see in France 90% now. So up to a point, do-it-for-me trend has still to come up in several European countries. Okay. The second issue they face is that up to 2016, gross profit led the expansion of EBITDA and EBIT margin. Company presentations indicated that gross margin expansion has been mainly driven by pricing. This 10-year record of margin expansion ended in 2016, and well, up to a point due to currency and cost inflation. 2018 has been the second straight year of margins erosion, and the outlook for this year points to another weak year in that sense. Several factors, mostly cost of sales together with inflation pressures in the UK, also up to a point as a consequence of the GBP depreciation. As I said before, they hold a slight long position here. Additionally, 2019 points to more margin pressure from one-off costs, mainly due to the closure of Netherlands and Germany, which is nearly between 15 and 20 million one-off cost. Again, however, and that's what I like most like in Howdens. Howdens has a relatively strong amount of pricing power, given its route to the market. I mean, with sales made on a B2B basis, significant discount against an inflated list price, there is limited pricing transparency. So sales up to February increased by 5.1, like-for-like by 3.5. And most important, when you see return of capital employed, it depends on how you calculate, as you know, but you don't see the same decline. I mean, this is due to the fact that each depot has a relatively fixed cost base with a low required investment to be rolled out. Must be noted that the two sites they operate in the UK dates back more than 15 years. So it is completely depreciated. It's a purely asset-light business model. So while only a third of production is made in-house. So as I said before, it is a much more outsourced company than most realize. So, well, CapEx as percentage of sales, to give you a number, including expansion CapEx, it is no more than 4 or 5% of sales. So it's quite light. Therefore, return of capital employed is stable above, for me, 80%. 80. For any others, can be above 50%. It depends. But in any case, it's a huge return. Well, honestly, few listed non-IT companies are trading on these returns, as you know. Following up with the balance sheet, 35% of the equity position right now is net cash. So working capital has been proving quite volatile since they give the builder up to 8 weeks to pay. It's another key point compared to traditional retailing, where, as you know, they pay upfront and pay. They get the payment upfront and they pay 90 days or whatever. Here they give up to 8 weeks to pay, but working capital on sales is no more than 10%. In my estimates, cash conversion cycle range between 30 and 40 days. It is not bad. Okay. Honestly, it is coming from 25, 30 days, so it's quite volatile, but especially since, well, due to Brexit and things like that, they are building some inventory, and must be know that it is almost purely matched with the fact that it is the most expansion period ever in the company. So ramp-up period has never been as strong as now, okay? So I estimate that holdings need no more than 200 million to run with returns of at least 40, 50%, okay? The third point is the UK, for sure. Well, we must be aware holdings is up to a point a cyclical business. Don't forget about they are selling kitchens on a B2B basis. For now, 95% comes from UK. And historically, as you know, it has been a clear correlation between real estate market and KPIs such as GDP, consumer confidence, PMIs, and things like that. So UK with Brexit and is a sector under pressure. And that's what attracts me. I mean, there's no doubt that Brexit has a negative impact on the UK's equities. And it means that many stocks are now undervalued and represents an attractive proposition, of course, in exchange for short-term volatility. My fourth point is management change. Founder Matthew Ingold retired last year as CIO after 22 years in the role, and it was succeeded by Andrew Livingston, up to that point CIO of Screwfix, well, it's a subsidiary of Kingfisher. One of the main issues he faced is the exposure of cyclical, competitive end market, and in a sector which is driven by consumer demand for a big ticket purchase that can be readily deferred. For now, what we know when we have a chat with the company is that a number of initiatives to make the business even better are on the way. Livingston believes it can make space utilization improvements of around 25% and to open up to 850 depots, while smaller depots, that's the key answer, between 500 and 900 square meters. So, and CapEx as percentage of sales will increase up to 5%. It depends on the sales, obviously, but they are guiding up to 60 million when they came from 45, more or less. So, the fifth reason shares are unappreciated, in my opinion, is that at £5, which is about the current stock price, shares don't appear particularly attractive or cheap. It is trading at 5.3 times book, nearly 6 times earnings and 11 times enterprise value operating profit. Well, looking at these charts, we can realize that it is broadly in line with its historical average. Maybe slightly above in terms of free cash flow yield, but should be pointed out that the group has never been as cash generative as now, mainly in terms of free cash flow per share. And even despite CapEx on DNAs has been increasing, and after all, in my numbers, in my estimates, Holdings trades now at nearly 7% free cash flow yield when CapEx, expansion CapEx, and working capital are normalized. So, just to give you an idea of how cash generative it is, after having returned nearly 20% of 2014 capitalization, both through buybacks and dividends, it has left a net cash broadly stable at 230 million over time. And at no point in the past did the group utilize any borrowing facility. So net cash is expected to increase over the coming years, that's clear. And the scope for M&A is limited. Just to give you another figure, all this track record is organic. Okay, there's no M&A. Seems to be likely the company further buybacks will come up. And for most, the chance of a European rollout in French, mostly in French, could consume the increased level of cash, but well, I strongly believe cash generation is an ode to both, to return cash and to invest in growth. So this means we do not have to look at cold numbers or static multiples, but at how they return cash, they compound over time, and how they cheapen over time. It is a purely component story, right? Lastly, to see other players at glance. Well, it is honestly hard to set a pure peer group since, well, Holdings, benchmarks, and Magnet all sell through more or less the similar way to Holdings, but unfortunately none of them, with the exception of Holdings and Novia, are directly listed. Well, namely, Wix is what they call home improvement retail, and in that case owned by Travis Perkins and ultimately struggling. Well, if you see these charts, you'll see that, well, this is a construction sector, more or less, just to pick up to a point, a peer group. And you see that it is interesting to look at how Holdings trades compare, but not only in terms of standalone multiple, such as enterprise value, EBIT, but also as a function of margins and return of capital employed. And discount is clear in that sense. Okay. Well, based on a normalized free cash flow calculation, I estimate it could be rounding 400 million in 2023. 6% it means 3,300 millions. Then we ought dividends received up to that point. Then we add net cash position. We estimate they will hold at that point, which is it's going to be nearly 250 million. And this led us to at least £7 a share, which is nearly 40% above carbon price. That's true, we are talking about 5 years, but if you discount at any interest rates, UK interest rates, it means that you are nearly £6.7 a share. So basically, that's my final slide. I think broadly speaking, it is a a ramp-up story in its final stage in the UK, and that means a margin expansion or margin stabilized in the worst case, combined with even improved cash flow profile from an already asset-light business model, and not to mention the optionality they've got through French operations. So sometimes I think we are, up to a point obsessed in trying to identify ramp-up stories in its initial stage, just looking at KPIs, such as top-line organic growth or just the number of new branches opened through the year, but usually in exchange for a poor cash flow and typically with high leverage. Here, what I see is a company which has been always highly cash generative, despite it has been strongly investing through the latest 15 years. Now it is maybe time to get some profits, and this means a huge amount of cash must be returned, again through buybacks and dividends. So that's basically the presentation. Thanks very much again for listening to me. It's Q&A.
Thank you. Any question? Thanks. I got a question on IKEA, how they're behaving in the UK, and also on the French market where Nobia had big problems making money. How is Howden going to make money in that market?
Yeah. Well, it's a good question, since international operation means only 5% of sales. It is not fully disclosed for now. And if they fully disclose now, I'm sure that we'll see that French market is not operating with same margins, with same returns. It's to a point it's unstable, since they have only 20 depots. But what you say about Nobia is quite true, but must be taken into consideration that Nobia in France has low penetration, a bit higher than Howden's, but and up to a point it's not the same business model. They are not as asset as Howden's. So, and to give you the answer of IKEA in UK, you said?
Yeah.
Well, Howden's is the first player. They always say that they have market share of nearly between 25 and 30%. IKEA, it is estimated it is in the same level, I would say between 20 and 40% of sales. But what is clear is that do-it-for-me trend do-it-yourself trend in UK is much lower than in French, but in the past represented above 80%. Okay, I don't know if that helps you.
Thank you. I was wondering how you think of the defined benefit obligation they have. I look at the company like 4 years ago or something like that.
They have a defined benefit obligations like many UK companies. We are talking about, I think it's nearly 150 million, but in any case, this deficit, we are reducing this deficit from the net cash position. So to be more conservative in that sense.
My issue with them back then was that of that 150 million, I don't remember how much was that back then. They had an aggressive allocation to equities. So in a market downturn, you'd have.
Yeah, but as you know, but this is an actuarial calculation. If you have 25 years from now on, you can be up to a point a bit more aggressive. And it's not the same as if your personal has only, let's say, 50% of your personal will retire from 10 years now. So, yeah, as you said, it's true. They are quite aggressive in that sense. I think they are running between 15% or something like that of this pension is equities It's diversified equities, but yeah, it's true.
Anything else? No? Thank you so much.